Hello and welcome to the Friday market update. And we've got a big one this week. So, for the first time in quite a while, mortgage rates are now back in the fives, high fives, but they're in the fives. Both Mortgage News Daily Index and Freddie Mac are showing a five handle on the 30-year fixed rate, somewhere around 5.99, 5.98. That is a meaningful shift. It's psychological, but it's great. And we hope to shift down even further from here. Now, if you've been watching this over the past year, you've seen rates dip before and then snap right back up again. We would get a good report, rates would drop for a day or two, and then bam, a jobs report or some economic data would come in and push them right back up again. It felt like every time we got some relief, it was really short lived. But this time, honestly, it feels different. Instead of a quick drop and rebound, we're starting to see this more gradual, steady decline in rates. And it feels like Wall Street is being very comfortable with where they're at. And that's exactly what you want to see if you're a buyer, a homeowner. You want certainty, you want stability, and a real estate agent trying to plan ahead. Now, let's zoom out for 1 second. At the beginning of the year, 9 of the most respected forecasters in the country came out with their projections for mortgage rates. The average forecast was 6.18% for the 30-year fixed rate mortgage. We're below that right now. Our prediction was lower. We said we thought interest rates could get down to around 5.7%. We're now in the fives and we're heading in that direction. Who knows? It might get lower than that. And if things continue on this path we're on right now, we could be getting there sooner than people had expected. So what's driving all of this? At the end of the day, mortgage rates are driven by two main things. Number one, jobs. Number two, inflation. That's it. If the economy is running hot and adding a lot of jobs, that tends to push rates higher. If inflation is rising, that also pushes rates higher. But when those two things start to cool, rates come down. Now, here's where it gets interesting. There's a big question mark out there right now, and that's AI, artificial intelligence. We really don't know yet how AI is going to impact the job market. If AI starts replacing some of the data gathering, analysis, and administrative work that a lot of jobs rely on, we could see higher unemployment rates. At the same time, AI has the potential to increase efficiency and lower costs across a lot of industries, lowering inflation. And if cost comes down, that definitely helps reduce inflation. So if AI leads to higher unemployment and lower inflation, that is a recipe for lower mortgage rates over time. Now, how fast that happens is anyone's guess. They're still in the infancy of this AI thing, right? This could take years, but it's not out of the question when you look at the bigger picture. Now, let's bring this back to real estate because this is what really starts to matter. The latest Case-Shiller report showed annual home appreciation at 1.9% nationally. And on the surface, that doesn't sound like much. 1.9%, we've seen it much higher. It's been the average is way higher than that. But it doesn't tell the whole story. Because if you look at what's happened since the rates started to come down the last year, the monthly appreciation numbers have been picking up. So appreciation is based on a rolling average on a monthly, month-over-month basis. So if you take a look at the last 4 months and annualize that pace, appreciation is running at about 4.8%. If you narrow it down to the last 3 months, it's actually closer to 5.3%, not the 1.9% that's being reported. So what does that tell us? When rates come down, buyers come back into the market. When buyers come back, demand increases. And when demand increases, prices tend to rise. There is a very strong correlation between lower interest rates and higher home prices. So here's the big takeaway. A lot of buyers have still been sitting on the sidelines, waiting for rates to come down. Well, they're coming down. They are down. They're lower than most forecasters had predicted already this year. But here's a challenge. As rates drop, you're not the only one paying attention. Other buyers are watching the same thing. Do you think the media is going to come out and say, hey, we've reached the fives in interest rates? That's going to pique a lot of buyers. And when they start to move at the same time, competition picks up. It's just a natural thing that happens. which is exactly what pushes prices higher. This is where we have to talk about timing. A lot of people try to time the market. They want to time the market. They want to buy at the perfect moment, the lowest rate, the lowest price, the best possible scenario. And the reality is that moment almost never exists. It's just a fraction, a tiny time period. And if we're being honest, that window where you could wait for rates to drop without increased competition, I think personally, that window has already passed us by. So instead of trying to time the market, we have to shift the conversation to time in the market. Real estate has always been a long-term investment. You got to think 7 to 10 years. It's not an overnight success. If you're going to buy for a 1 to 2 year period, maybe it's not time to buy. So if someone wants to get into this market and really benefit, you have to be in the market for a long period of time. And over time, real estate has consistently been one of the best wealth building tools available for the average American. You buy the home, you live in it, you let time do the heavy lifting, and you don't worry about the day-to-day fluctuations in value. Who cares? You're living in your house and it's going up in value almost every single decade that you live in it. Because over the long run, history has shown that real estate rewards patience. So as we sit here today with rates back in the fives and trending lower, the opportunity is starting to shift. The question is no longer, are rates going to come down? The question is, what happens when more buyers realize they already have? If you've been thinking about making a move, this is a time to start having that conversation. Get the numbers, understand them, look at your options, and make a plan that fits your long-term goals. Get into that ideal home. As always, if you want to take a deeper look at your personal situation, reach out to our team. We're happy to help your clients get into their home. We're helped to make all the decisions, feel comfortable, and they're confident going out and making a purchase. So hope you have a great weekend, and we'll see you next week. Gaylord out. Bye, everybody.